Hi there. Welcome to another edition of TokStocks. I'm your host, Keir Reynolds, and today we're lucky enough to have Sean Black, CEO of Happy Belly Food Group, here today. It trades on the CSE with the ticker HBFG, Happy Belly Food Group. How you doing today, Sean?
Great, Kier. Thank you for having me.
Hey, thanks for coming back. We've done a few of these over the last couple of years and watched you guys go from an idea to, now I think if I was reading not too long ago, you've now opened 50 locations under your sort of restaurant and sort of brand group. Congratulations on the milestone.
Thank you very much. It took longer to get there. I probably lost more hair doing it, probably developed a couple extra grays along the way, but we did it. I believe the team is better for it, and we're stronger than, both operationally and financially than we've ever been as a company. So, the first 50 was hard. I think the next 50 is going to be a lot more fun than the first 50.
Well, that's still remarkably fast to where I sit. This is maybe 2.5, 3 years in total time. That's remarkably quick compared to a lot of the unrealistic milestones that other companies sort of put out there. 50, having to go out and identify real estate, renovate, find franchisors and or finance it and build it, manage all of the trades to be able to get these things open on time. That's just phenomenal. I don't know when you have time to even sleep.
You know what? There's two parts to this business. Obviously, there's a capital market side, and then there's the run of the business and the fundamentals. And the good news is 80-90% of our time is focused on running the actual day to day of the business, and that we've definitely benefited from that. We've definitely had to increase our bench strength. Previously, we announced we brought on Gary Fung, who used to be head of finance for Tim Hortons, as our CFO. We brought on Randall Papineau, is running IQ Foods and continues to expand his role within the company. He previously ran Fresh for us, one of our previous success stories. And recently, we brought on John DeLunis in the fall as our vice president of operations. And then today, we announced him as our new chief restaurant officer. So you're right; it wasn't easy. We've assembled 9 brands today, 50 restaurants open. Total, we have 521 restaurants in development across North America. Now, when we first started, I think our first chat with you, we probably had 30 in development total. So we've come a long way, far from where we want to be. I think we constantly are probably in our own minds changing our own guidance of where we believe we can build this. Because you're right, when you and I first met, I think we were probably at 10-cent share price or 8 cents. We were not very promotional. We were pretty boring. And for sure, that challenged a lot of investors for microcaps because, an 8-10 cent company that, is full of promise but hasn't yet delivered, it's really hard to attract quality investors, right? It honestly is. And I understand why, people resort to other measures to try and get shareholders in. But we took the long, probably boring, painful road to, in my opinion, success because we've been able to, raise money above price. We've been able to bring in strategics from some of the larger funds in the country, and to your point, yeah, we've been able to attract top level franchisees across Canada. We've had some great partners from Cadillac Fairview and Choice Properties and some of the biggest REITs in Canada that have supported us and opened the doors to their portfolio. That helps, but attracting quality franchisees usually comes down to they're not buying them because I'm cute. They're buying them because the unit economics on our brands are excellent. And that is typically what's attracting them. So we've definitely went back to the well and brought some of our old franchisees that have done well with us in, and they've shared in the success to us today. The good news is every single franchisee that we have today is also a shareholder in the PubCo. And that's a key strength of ours. So yes, we're very lucky. It's come a long way to 50. It took longer, but as a company, we're sitting here today. We have just over $100,000 of secured debt on the business. Royalties in our business, including all the corporate stores that we've funded. All the corporate stores that we've opened are debt free and cash flow positive. As a business, so that's what's important to us. Is to build a long term compounder, and I think we've just rounded first base.
Hey, well, good to hear that, and lots to unpack there. So before we get into all that, why don't we get our 60-second stock pitch out of the way? Let's keep. I'm going to drill you some questions. Give me a quick answer. First one: what is the name and stock ticker of your company?
HBFG, Happy Belly Food Group.
And what's the mission and vision of the company?
We want to be the leading consolidator of emerging food brands in Canada.
How many shares are outstanding today, approximately?
About 126 million.
And who are some of your major shareholders, and how and what percentage does management own?
We have some institutional investors that have come in. One of them was K2 out of Toronto, large fund, and we have some other ones I can't disclose, but the ones that I can disclose would be Trio Capital, which is a great guy, friend of mine, Paul Paletta, out of GTA. Some very successful entrepreneurs that have supported us and been part of the journey. So we're lucky there. When I started, we were sub 2% insider ownership. As of last report, I believe we just passed 24.5% insider ownership. So we've added and we continue to add as a team.
Are you fully funded for the balance of 2025?
Yes, we are. We're fully funded. We've had some strategics. The last one of our strategics just put equity in at $1.50. So we're sitting very comfortable with our cash position, and no dirty financing is coming that are going to get dumped on our shareholders.
We don't like those, do we?
No.
And you guys haven't had any of that in your short.
We've never done a down
company
round
track
in the
record.
company's history, and we've always raised 50 to 100% above market.
Yes, totally unique, exceptional. What are a couple of short-term catalysts that we should watch out for?
You know what? I hope the number one catalyst this company always gets based on is our financials. So our Q4 fins will be coming out late April. And then our Q1 fins, which just closed, the quarter just closed, will be coming out in May, towards the end of May, and then August. Obviously, yesterday we just had the single biggest day in the history of the company was actually yesterday from a sales perspective. We had a National Acai Day, so a big day for Heel and the company in general. So yeah, single biggest day in the history of the company. So that kicks off our Q2, which will come out in August.
Excellent. Well, thanks very much for going through that. Now we can unpack some stuff. So last time you and I chatted was in December. It's only April, but boy, golly, it seems like the whole world has been sort of turned upside down. New U.S. administration sort of come in. They seem to be a big fan of, putting things out on social media.
Yeah.
We've also got a Canadian federal election, which is sort of going on. And we've got the T word, tariffs, which has sort of been causing a lot of issues out there for businesses and also for stocks and whatnot. Maybe we can talk, a couple of things that have kind of come out of that is with U.S. basically sort of declaring what some would say is economic kind of warfare against Canada and the implementation of high tariffs, or the discussion of it. I can't even keep up. Do we have tariffs? Are they?
Tough.
What is the tariff percentage? What's the carve out? It's really hard to sort of keep up with. However, one of those things we've kind of read about is kind of supporting Canadian companies and Canadian products. How does that sort of benefit you guys?
You know what? There's a few levels that it's certainly impacted us, but in a very positive way. We've had large vendors across the country. I think we just added an additional 150 Loblaw stores that came in and essentially purchased the remaining supply of ours for the rest of the year as they're looking to buy Canadian. So on our CPG side, that was very beneficial. And consumers are, you do see it in the stores. People are walking up, looking at the bags, looking at the sourcing, seeing where it's from before they buy it. I was speaking to the gentleman at the butcher the other day, the owner, and a nice guy, and he said, Sean, he goes like, if I bring anything in that's U.S., people are literally leaving it on the shelf. He's seeing it at his store level. So I do see a few things. I think at the moment, buy Canadian is very real. I do think people are traveling a little more in Canada. There are less visits to the U.S., and that's impacting our sales in a very positive way. As well as I think when you see, there's what we call dine down in the business. And I do think a lot of people might be showing up at a Rosie's Burgers or a Yolks and, I'm going to say a Heel, not only to eat clean or eat better, but instead of going to the keg or instead of showing up at a, larger full serve, they might just be picking up dinner and taking it home to the family, or they might be stopping in at a QSR and spending, let's say $50 to $100 for a meal for the whole family versus spending $200 to $400. So I think there's a few factors at play here, but we are seeing an exponential positive impact to our restaurant level sales. Even reviewed one this morning in February. As weird as this is going to sound, like we had margin improvement in some of the restaurants in February. So our costs have actually come down. So we've been very fortunate. We've partnered with one of the biggest distribution companies out there, Cisco Foods. Cisco came on board and became our national partner, gave us better pricing. Some of our delivery partners, Uber, Skip, DoorDash, that kind of stuff, they've come to the table. And as we've scaled, there's some key metrics in the company. And as soon as you hit certain store counts, and 50 of them is that number 50 is actually one of the milestones, you then qualify for larger pricing and national pricing. So we've actually been able to, on some of our brands, be able to reduce prices on some key items and some key suppliers. One of them is a large New York Stock Exchange company, Toast, which is our POS and tech stack provider. We've just done a new deal with them and been able to get better service, and that was announced recently, and better supply into our stores. So scale is helping us at the moment. And for us, north of 90% of our products are all sourced from Canada. So we had very limited exposure to US supply on some stuff. So we're very fortunate. And thankfully, our labor position is good within the brands. Our store, we have currently, I think Q1, we had a record quarter of openings. Net new openings were up 700% in 2025 over 2024. And I'm anticipating in Q2, our net openings to be up somewhere between 1,000 and 1,500% for Q2 2025 over 2024. So the biggest challenge we're having is actually keeping up with supply. I had a call from one of our suppliers the other day and say, "Gee, Sean, your supply is up, your purchases are up 300% this year." So we're having a challenge even forecasting this kind of growth. So we're very fortunate. We've got great partners, and majority of our products are Canadian sourced. So we're positioned well for buy Canadian, shop local, and to be able to service the demand. Even including, we're seeing the back to work, back to the office has been a catalyst as well in the business recently. A lot of people are going back to their offices, so we're seeing catering, spikes in catering, downtown business is up. So, we're very happy with where we stand today.
Excellent. Well, just for a little bit of a refresher for those of the viewers here that might be seeing this kind of for the first time, this isn't your first rodeo. You've been involved in the QSR and sort of restaurant industry for a while. Maybe you could talk a little bit about who you and your team, what you've kind of done before.
Sure. Yeah, definitely started in the business, opened my first restaurant when I was 19. But I got, into the franchising side. Our first venture was Extreme Pita. Alex and Mark, two of our board members, were my original partners. And we built that brand to about 100 stores. Then we launched our second chain, which was called Mucho Burrito. We built those two entities to about 320 some open, and I believe in about 70 in the pipeline. So we're about 400 stores. Sold it to a public company out there today, MTY, out of Montreal. And I became, as part of that deal, their chief development officer. Enjoyed my time there, learned a lot, brought a lot of that with me. And we went and started our next venture, which was Crave It Restaurant Group. Two of our lead assets in that company were Burgers Priest and Fresh, plant-based restaurant, fresh plant-powered. Built those up and vended them into, which is now Fairfax, which was behind the scenes our partner during that time. We had a venture cap partner that joined us, and Recipe and Fairfax. So great learnings from both sides. And that sort of brought us to the point once we exited and sold to which is now Fairfax. Um, we were like, okay, what next? And that brought us to Plantico, which as we built and became a little more agnostic, we diversified and changed the name to Happy Belly. So not our first go in the rodeo. No, we've had several exits in the business, built them from scratch, bootstrapped them, typically with just our own sweat equity in the business and cash in the business. Always on a debt-free, cash flow positive, and so this is really my second round in the public space. Obviously, I was an officer of a public company previously, and now here we are a second time around and bringing the operating discipline, I'm going to say, of what Fairfax and Recipe will teach you. I think they're one of the best in the business at operating a disciplined business. And I think if you look at up till 2018, 2019, when the transition happened, when Stanley Mall was the CEO of MTY, I think he was one of the best to ever do it. I think as a consolidator and a compounder, he took that share price from 8-10 cents to 74.50 on the TSX. So they were one of the best success stories out there. And are we using his playbook? Absolutely. Disciplined M&A, but then also borrowing a page from Fairfax and being a disciplined operator. And to your point, I think that's what's enabled us to excel at the pace we are today. It took MTY, I believe, 23 years to get to 9 brands. We're at 9 brands in 2.5 years. So, we're doing very similar, but on a accelerated playbook and trying to lead by organic growth versus just M&A, which is a little more cap friendly at this point, allows us to reach, positive cash flow and, earnings per share positive, which is the next big phase that we're trying to chase. That's what we're after. Just disciplined consolidator in the space and using the experience we had on the private side and the public side to get there.
And excellent. Thanks for the background and congrats on all the success. And what I thought was kind of interesting is you provided everybody a ground floor opportunity, a seat at the table right when you guys got going. So it wasn't like you built this all private with your own money and then took a public at some large valuation. Retail investors, somebody who didn't have a lot of money, could go and buy whatever number of shares on the CSE and really kind of get a seat at the table with you as you are building from your
we actually funded the business at 20 cents. And if you remember, it traded down, I think with the tax loss selling and that happened after us, it was trading at 8-10 cents. So a lot of people actually had a lower cost average than I did at the start. But we kept buying in the float. I think, Sean Moniz, remember, went from 2 million shares to 10 million shares, just buying stock in the float. So when he was the CEO and obviously the founder. People did. And we could have went out and raised money and started at a much higher price and probably started with institutional money or fund money higher. But then, to your point, the retail guys wouldn't have been able to get in. They would have been buying it at a much higher price and the big guys would have sold to them. Well, now the beauty of this is everybody had a chance to buy. And as we, the guys that believed in us and supported us early are getting rewarded. We've had 10 record quarters in a row. We're on a mission to continue that path in 2025. And just be disciplined and reward shareholders. Just be, and long-term compounding I think it's actually a lot of fun, although it's, as a business model, it's pretty boring. I'm not discovering gold. I'm not curing cancer or anything, which I wish I could. But you know what you know and stick to what you're good at. And for us, we're just good at being disciplined growth operators.
Well, yeah, unfortunately, I've had a whole background in sort of investing in mining, so I'm going to be invested a little bit in gold. But you guys,
I just don't know about
it. You guys have certainly been anything but boring. You keep using that word, which we've often gone back and forth on. I think you say it just to bug me, but it's working. It's working. You guys are anything but boring. You guys have opened a lot of restaurants. You put out multiple news releases seemingly each week. And I don't know when you sleep because as busy as I know you are, watching your Twitter feed or X or whatever they call it these days, I'm watching all the flights you're getting on, all the cities that you're touring, all the behind the scenes of what's going on. It's very exciting, actually, just to see how much hustle you have. It would be really refreshing if we saw more executives take this sort of approach. So I'd say it's you might think you got a boring business, but you're anything but boring.
Well,
You're
the
a
model's
very
boring.
exciting to
The
follow.
model's boring. But you know, the number one thing we did that on, Kier, was to be transparent. And
Sure.
I think there's a, in small micro cap stuff, I think there's a sincere lack of transparency from a lot of companies.
Yes.
And when you're trying to build trust and you're trying to be honest with people, then you got to open your books. You got to open your, you got to open your, what's going on day to day. And I think you'd be silly in this day and age with the access to social media and stuff that's out there to ever think, the way that, Mark Leonard did it, or early on Stanley did it. Social media and stuff, when those guys first started, that didn't exist, right? With
Yeah.
Constellation, what he did was amazing, but it'd be really hard to start that today, unless you have an incredible, amount of personal wealth, or, sincere, you're willing to spend it on marketing dollars or something else. You know what I mean? Like,
Sure.
you got to do it this way. So we bootstrapped it. To your point, we've hustled. We've been hustling hard, but we didn't get in this to build it to $1. Like, our payday doesn't really start getting good for me until we get it to $2. And as you'll see, even this morning, for John DeLutis, who joined, he got those purchase warrants. He's got to help us get it to $2 by June of 26. And then to purchase those million shares, he's got to cut a check for $1.11 million. So he didn't get any free stock. You know what I mean? So our team is very invested. Gary, our CFO, when he joined at around 18 cents. By 6 months later, when he got his warrants, the share price was 44 cents when he got his options. So again, next summer, he's going to cut a check in the treasury for over $400,000. Plus, with my partners and I, we have to cut a check for $5.4 million by next summer in the treasury. So you start doing the math pretty quickly. There's going to be, $6, $7, $8, $9 million by next summer going into treasury by June 26, assuming we earn the right to buy those shares at $2.
Excellent. Well, thanks for a bit of an overview on that. You're presently trading just over $1, if I'm not mistaken.
Yes.
We've had another bit of a wacky period of time. However, that said, you guys have been holding up quite well. In spite of everything, I think you maybe touched on a couple of reasons why that is. You're not greatly affected by tariffs. You are Canadian sort of content. So one of the things I asked you before we started recording is, I said, are you starting to feel? Are you getting any, sort of sense of consumers that are now sort of going out and seeking your brands, knowing that they're decidedly Canadian, versus having this sort of push and pull sort of feeling of, well, there's a KFC or there's a Burger King. Yeah, it's probably owned by a Canadian franchisee, but it's kind of an American, sort of brand. The franchisor is sort of American. Are you noticing any of that sort of stuff happen, where people are going out and saying, well, maybe I'll try Rosie's Burgers or Yolks for breakfast, or something, where maybe they were doing something that looks to be a little bit more American in this sort of like tariff sort of war?
Yeah, I think there's two things. I think social media for the younger generation drives a lot where they do buy. I don't say it meanly, but I don't know many young people day to day today that say, I'm going to say teenagers that go, oh, I really want to go to Wendy's today, or I really want to go to Burger King. Like, it's probably not rolling off their tongue very quickly. You know what I mean? The first choice. I do think, though, that's part of it. And I do think the other part is, yes, today a lot of people are buying Canadian. It's the only way to explain the same store sales increases that we're experiencing in some of the brands. They are above average for industry. Spoke to a guy from one of the largest restaurant chains in North America the other day, and I said, what's your budget for the year? And he says, well, we're chasing 4%. I said, are you going to hit that? And he goes, oh, heck no. And we are like we're experiencing double-digit same-store sales increases. We're not experiencing negative, or certainly not chasing 4%. You can't be an emerging brand and chasing low single-digit multiples in your growth. That'd be a really painful business to be in.
No, we're going to touch on the T word. Now, what about the I word? Inflation. I've asked you last 3 or 4 videos. What are you sort of getting? What's your read there in terms of like food inflation, things that might be sort of affecting your business? Are you still now getting some economies of scale by having so many sort of businesses that are that so many brands are now operating and using food service like Cisco you mentioned? Are you starting to get some economies of scale to help sort of improve that, or are you noticing that that could be an effect?
It
Uh,
is. It started for sure, and I think our better buying power as we're scaling is helping offset some of the smaller increases that typically get passed on from manufacturers or distributors. A lot of them come in and they want their 2 to 4% annualized increases built into their costs. And the good news is, as we scale, our buying power is getting better, and we also have the leverage to switch suppliers. You know what I mean? Because once you get bigger, all of a sudden you get a little prettier, and more people want to take you to the ball. So you get a lot more invites to dinner or some of that as they try and secure your business. So we're definitely using that on the purchasing side to improve our numbers. We've seen probably some brands experiencing some upwards pressure in costs, but then I also just had a call with one of the brands this morning. Last month our costs were down 2%. You know what I mean? So we had margin improvement on that brand. So to your point, yes, there is some pressure out there across the board, but scale is helping us offset it. Very few of our brands at the moment recently, we have one right now going through a price increase, but that's the only one I know of at the moment that's having a price increase at store level.
and what's your sort of approximate market cap today?
About 135 million.
And what do you sort of what do you talk to investors about in terms of like valuation of company stock versus sort of like annualized sales? You're trading. If we looked at traditional sort of value based investing, you'd be trading at a pretty strong multiple for the sector. Um,
Yeah.
is that offset because of your fast growth? Is that offset because now they're attributing value to the management team? What do you sort of say to people when they're trying to understand if there's more upside here?
Well, to your point, we went from one restaurant I joined, we're at 50. We've got another 521 in the pipeline. So pipeline, if you value track record of execution, the management's team ability to build and exit and multiple times in the Canadian industry, and you look at 10 record quarters of growth, the company at the moment that is fully funded. We've been able to, I think, start to clearly message that we have predictable growth for the rest of this year. It's a little bit like a cruise ship. Once you get it takes a while to get started. You burn a lot of calories to get a plane off the ground or get a cruise ship to move. But at this point in time, you couldn't stop us from growth this year. Like, I could take the rest of the year off. It doesn't matter. The company's going to grow. The growth is built in now for 2026. As I mentioned, I think we'll deliver Q2 somewhere between 1,000 and 1,500% net unit growth. We have restaurants already booked for Q3. We have restaurants booked for Q4. And I've just actually started signing restaurants for 2026 openings. So we are going to become very predictable growth company. And to your point, like, that is not your friend. I would not want to be a company today sitting there with 500 or $1 billion in debt, trying to be nimble and trying to move and navigate through this territory. We can do things that help our franchisees in ways that other companies that are leveraged, highly leveraged, would be hard to do because there's only so many dollars to go around. And in our position, if a franchisee needed help or something like that today, we can lean in and we can help them, and we can open corporate stores because not only does our unit economic model work currently, but we have the cash to do it because it's a bit of a tough spot right now. I was speaking to one of our shareholders a couple of days ago, and it's exactly what he said to me. And he built a business from, I don't know what it was. I think 20 million to north of 500 million, and an incredible individual. Respect him a lot, and it's his exact line to me: "Debt is not your friend." So, I'm not. We're very comfortable with our position. We're able to. We're accelerating growth into this market. So I hope that if once people see Q4, Q1, Q2, Q3 numbers, and despite the noise in the market, if we're able to have positive same store sales and expanding our unit count dramatically without needing any more capex, or to raise money, I think that's we'll come out of 2025 with some very happy shareholders. Our goal this year was to come in and try and double the business from 2024. So if we can double our business and improve our margins this year, I'm good with that. And then ideally, we'd like to exit 2025. My personal goal is to be cash flow positive, earnings per share positive, and debt free as a company.
Okay,
I
excellent.
can't promise any more than that. That we'll give it a shot. That's all.
No, I think that's a great answer. Thanks very much for going through that. Can you? I'm not sure if I've seen this before. You announced a CRO this morning, a Chief Restaurant Officer.
Yeah.
What's John DeLutis? What's that sort of role sort of encompass?
Well, I'll give you a little background. John joined me originally. Joined us. We were 17 stores with Mucho Burrito. He came over as brand vice president of Mucho Burrito. Helped us build that to just shy of 100 when we sold it to MTY. John then joined me at MTY as brand vice president and built that brand to about 150 stores. So, post his time at MTY, I was very lucky to be able to get him to come back. He joined us in the fall, and he'll laugh at this one, but I tasked him with a couple things. I said, I'd like you to take a pay cut. I'd like you to get no stock options, and I'd like you to work your ass off buying the float right next to me for the next 6 months. If you do that, then we'll give you a seat at the table, and you can get some warrants, and we'll revisit your comp. But for the first 6 months, it's going to hurt, but you're going to earn it, and you're going to earn the trust and respect of everybody in our team and our shareholders. And that's exactly what John did. So I'll go to war every day with him in the field with him. Like, he's awesome. I respect him a lot. He's had a meaningful impact in our company since he's joined in the first 6 months. So Chief Restaurant Officer, and the key to that role is, there's really, I think it's a mistake for companies not to separate the pubco from the actual restaurants.
Mhm.
It's two different worlds. And John today, day to day, I need guys that don't watch the share price all day. Go run the business. Go be functional, boots on the ground in the field, and that's where the money's made. It's in the restaurants, right? It's not made in the office. So John is 7 days a week dealing with the team in the field, business plan, strategy, overseeing purchasing, all departments of the company today that affect our restaurants. They go through John now, and I'm very lucky to have him. But he doesn't touch anything on our CPG side. So that's why I separated the business so that we have dedicated eyes and hands and ears only on restaurants, and the CPG is pushed off on its side on its own, and he doesn't have to focus on anything else other than driving the EBITDA at restaurant level. So very fortunate to have him, and in my opinion, MTY's loss in our gain.
Well, great. Thanks for walking us through that. In terms of, you mentioned you got 520, 521 sort of stores in the pipeline. These are restaurants. What percentage of those would be corporate owned versus franchise?
Ideally, in our growth model, we're allocating 10% of the stores to be corporate. So today we are about that. Of the 50, we're just over that today. We have, I believe, 7 corporate stores, eight corporate stores. So we're just over the 10 mark on the 50. But as on a go forward basis, I'll anticipate about 10% of our stores at the moment, about 10% being remaining corporate. And when we do corporate stores, we prefer to do them that way because we're using free cash flow that's coming from those individual assets. We like to reinvest the free cash flow in accelerating growth. And to give you an idea, we have several of them underway. And let's say you open up a corporate store, and as an example, say it does $1 million. Well, if it might generate 50, 60, $70,000 in royalties and rebates per store on a per store basis. But if you open up that store, your margin could be, let's say, 15%. So you can double your margin and returns on corporate stores, so they can be quite lucrative, but they just require capex. So rather than always raising money or doing stuff to open more corporate stores, we're trying to use free cash flow off an asset to accelerate corporate store growth, which would eventually also increase our margins. And as you do report numbers, when you have a franchise store, you only count the royalties on your corporate revenue. But when you open up corporate stores, which we have a few of them that are very meaningful, including the Rosie's that's going to open this week, being a corporate store, they are very meaningful to our financials because they report 100% of their revenue to the corporate store side. So it's big. If you look at some of the brands that are valued at a lot of money, Cava, which is still, I think, $7 or $8 billion. They only have 350 corporate stores, right? They don't have any franchises. So for us, we're at 50 and growing, and we will look to, on average, 10% of our stores we'd like to keep corporate. If as free cash flow increases, that might change over time, but at the moment, our internal budget is 10%.
Well, you're getting good on these interviews because you knew right where I was going, and you've cut me off at the pass. So thanks for answering that. That's good stuff. So you mentioned this thing called Toast earlier, and you made a news release about it. What does that sort of allow you to do? Does it allow you to, like you mentioned, hey, yesterday was like our record day. Is that something that like this Toast thing's able to do? Are you able to see like what's going on in all of your locations?
Yeah, so let's give you an example. Toast is great. Obviously, we've been running a test pilot for it and slowly onboarding our stores. By end of Q2, we should have all brands onboarded to Toast. But if you're looking at it on my phone, I literally just tap the app and I can quickly go by brand, and I can pick the day, the month, anything, and I can quickly access sales, average check, detail, transactions per brand. So yesterday, at the end of the day, when we have a record day across the company, absolute monster day, I'm able to get pretty excited and watch it. It happened. So it's very real. It's live. It's real time. And all of our team has that, so they're quickly able to assess as well if if a store is experiencing something. You're probably on there and checking with the store and seeing if they need something. But it's a great tool for us to watch. It also is, for me, very handy on real estate to see which ones are resonating, where the brands are resonating, what day of the week is busy. The marketing team can use it to see where they need to lean in. But Toast is, brand new partner of ours. Obviously, I think they're close to like $18 or $19 billion market cap company on the New York Stock Exchange. So between them, Cisco, and I think some of the other partners that we will likely work with over the next 3 to 12 months, I think people will see we're building out our platform, solidifying the base of the company, and we're positioned for significant growth over the next 12, 24 months.
In terms of your mix of brands, you said you've got 9, if I'm not mistaken. And those, how many of those are sort of restaurant brands? Are all 9 restaurant brands, or are you including
all
your
9 are restaurant brands?
Okay.
We have two CPG brands.
Great.
And the 9 restaurant brands, the leading one today is Heel. We have 19 restaurants open, with significant growth planned for that brand this year and in 2025, 2026, I should say. And then the two CPG brands, we have a cereal brand called Holy Crap, and we have a popcorn company called Lumberheads, which, both of those brands, we're lucky. They're both cash flow positive, debt-free, both experiencing significant growth at the moment. I think for sure on the popcorn brand, I would say we're sold out at the moment. I don't think we can possibly produce any more for the remainder of the year. So we're very happy with where those are positioned, and they're not a core asset of the company. But you know what? I'll never get tired of owning cash flow positive, debt free assets. If you ever have any or find any gear to sell me, you call me.
Sounds good. Well, that's great to hear. So in terms of Heel, that's sort of been your fastest. It's probably also the least expensive to get open in terms of a per location basis, because it's like a smoothie type of store, not necessarily needing a full kitchen and things like that. Permitting is probably easier, things of that nature. Out of your mix of brands, what sort of, can you give us a brief average sort of breakdown of how those are represented in their 521 sort of locations that are in the pipeline?
Sure. I think about 110 of those are Heels. I think about 60 are Pyro. I think we're getting close now to 100, I think, total across the markets of Rosie's. And then I think you're about, same thing, about 60 on Yolks. So, it kind of breaks down an average between, let's say, 40 to 60 per brand that are typically in development. The higher numbers would be Rosie's and Heel. And we expect to add more deals over the next 6 to 12 months. as we continue to explore asset light, typically growth model in those. So we just did announce the deal for Atlantic Canada. So we are now, I'll be out there in a couple of weeks. We're actively expanding into that market. We're just working on securing the real estate. We have franchise interest, brought in an area developer. David Wilson joined us recently. Previously, somebody we worked with as well. So now Atlantic Canada is going. We've now moved into deals for Saskatchewan and Manitoba. So there's, Quebec, we've announced Yokes. So Quebec, we're about to enter into a market. So hopefully, but in 2026, other than maybe the Northwest Territories, there's not any provinces left in Canada that we don't have any stores. Yukon and Northwest are probably going to be the last ones to be reached, but BC and Alberta, we're moving into in a meaningful way. We recently announced a 5-store deal for Rosie's. We already have Yokes. We already have Heel. We're accelerating our growth for our brands in Alberta. Now Ontario, Quebec, and Atlantic Canada are next on our radar. So now we have more verticals. We have more area developers as part of our model. So that allows us to accelerate growth because we've entered into more markets. So, if every, brand over time was to open 5 stores a year, and you have 10, 15 brands, you can kind of get to where we would target 50 to 75 stores a year. It would be our ideal scenario.
Excellent. And am I mistaken? Did you guys enter the coffee market?
We did. I did. I'm working on one this morning, actually, another location for it, but we acquired a brand called Smile Tiger. We believe, look, if you look at Dutch Brothers out of the U.S., but one of the real success stories lately, driving Starbucks crazy. They're the emerging kind of irreverent, anti-establishment version of Starbucks. They're doing a great job. So I think if you look at Starbucks recently, 75% of their beverages now sold are cold, which is, kind of shocking. And you think about they're a coffee company, but, energy comes in a lot of different ways. And that's what Starbucks is moving into. And so are we. We're looking at some potential combo stores with that brand. So maybe we tried one in Western Canada with Blends. That was a real success story. Blends and Heel, West Coast based brand. So we're going to look at some of them ourselves as co-brands. We're also doing one shortly coming up with Heel and IQ Foods. And since we last chatted, IQ Foods is one of our M&As that we've closed on. I think the last 2 we did was Smile Tiger and IQ Foods. And IQ Foods is the direct answer to Sweetgreens, and one of the OG brands in the category. Probably one of the best M&A deals I think we've ever done as a company. And
is that brand also fairly food court friendly?
It is. We have it in food court and street. We also have a deal with Equinox Gyms in Toronto. We're in the couple of the Equinox. We provide their base a meal program. But then we've since added it to Toronto Eaton Centre in a food court. And now the next one with Cadillac Fairview is Shops at Don Mills. We're under construction there, looking to open later in Q2 with a great street front footprint. We're opening right beside Chick-fil-A, Chipotle, Starbucks, and it's going to be Rosie's and IQ Foods and Heel. So great lineup of brands that we're entering. Again, those are corporate stores. All of that brand is corporate. That brand is very cash flow positive and debt free. So as that brand starts to show up on our Q4 fins. So Q4, Q1, Q2, you're really going to see the impact of both Smile Tiger in Q1 and IQ Foods, but Q4 you're going to see IQ Foods. So we hope to show investors in Q1, Q2 what this roll-up strategy looks like as we consolidate.
Well, excellent. We've covered a lot of ground here. I'm not sure if we really got into as much nitty-gritty as maybe some would like, but why don't I sort of hand it over to you? What are a couple of key items, or what's some upcoming catalysts that we should really be paying close attention to?
The biggest leading indicator that we have as a business is store openings, right? If anybody's following our story and they want to say, are they growing? Just follow the store count. Every quarter, to your point, we're always on social. We're transparent with openings. This will be Q1 was a record number of openings in the history of the company. In my opinion, Q2 is going to blow away Q1 for openings. So when we always announce the sites, the real estate's been announced. I'm not talking about anything that's not in the public domain. All the stores are coming. Just the only thing that people don't know is the opening dates. But they are under construction, imminent openings starting this week. This week we have an opening. Next week we have an opening. I think that constantly through Q2 we'll be opening restaurants. So if Q1 is a major increase, Q2 is a major increase. I know the financials are lagging, but the royalties, the corporate store revenue is hitting like in a material way every quarter. So for people, just make sure we're still opening stores and we're delivering organic growth, because that's how you compound the numbers in our business. So I think people want to watch for that. Just watch our financials every quarter. I always tell people, like, I've had some significant meetings in the last number of meetings in the last 30 to 90 days with institutions. We're finally, getting inbound calls, and we've had some great support from some lead bankers as they call and trying to find out our story. And full transparency, they ask, what are the chances that you're the next MTY? What are the chances that you're the next Boyd Auto Group? What are the chances you're the next Main Street Equities? What are the chances you're the next Constellation in my domain? And I always say, like, you know what? All I know is we're working real hard at it. We've had 10 record quarters in a row, and we're not stopping. Like, I actually believe we're just starting to get good at it. Our team has gotten much stronger. Our balance sheet's stronger. And we've actually decreased debt on the company to the point of, like I said, I'd like to be debt-free by the end of this year and cash flow positive. Nothing else for us. So
How many?
the
How many?
financials,
Sorry, go on.
the financials are the lead indicator, but our goal for the end of the year is to be 80 to 100 restaurants in operation, both organic and inorganic, which is a significant milestone for us. The next big one for us is 100 stores.
Excellent. And which just a couple of interviews ago would have seemed like a absolutely massive number, and here you are, you're halfway there. So good stuff. Congrats on that.
Thank you.
How many full-time staff now work for like Parent Co, work for like Happy Belly?
We're about 15 people at head office today, including from accounting to operations. And then the rest of them are direct asset related operators on the team. So you'll see them, they report directly to the brands.
Any surprises to the downside in terms of any of your franchisees that that are maybe not performing? Are you able to identify that and correct that?
We got one restaurant today that's real pain in my ass. I wish it was doing better than it is. So in the portfolio, I have one that's bugging me. Out of 50 restaurants, we have one. And the benefit is, over time, we'll look at that asset, identify the real estate. And is it the real estate the problem, or is the brand the problem? And if it's a brand that's the problem, then over time, maybe you convert it to one of your other more successful horses in your stable. But ideally, you work at it, you fix it, you grow it. But if you can't, the beauty of having a diversified portfolio is, especially in an emerging brands category, you're never really sure when you have 10 or 15 young brands which one are going to grow up to be the stars, right? You just don't know. You have 10 kids, some of them might be better in basketball than the others. And, we've definitely identified two and potentially a third and a fourth on the way. So we may have some great other ones that are just good horses in the stable. And then we may end up with, 1, 2, 3, 4 championship horses. And those are the ones that will accelerate. So again, real estate is an asset for us. So we will identify the real estate and find out what gets us the best sales per square foot, the best performance. If we ever have to convert a restaurant, we'll address that. That's okay. We're not perfect. We're not going to ever bat 1,000. But lots of guys made the Hall of Fame batting over 300. So, I think we're going to have a very good batting average, and we're going to grow significantly this year, despite tariffs, despite, politics, regardless of who gets elected in Canada, they won't get, in the next election, they won't slow down our growth this year.
Are you ever going to cook again at home, or you just got 9 brands you can eat out at all the time?
You know what? I actually love cooking. Despite what some people might think, I find cooking and doing dishes pretty therapeutic. So for me, when I ask my downtime in a day, I'm probably on a phone call cooking and I'm probably on a phone call doing dishes. A lot of people used to think I was, literally going to the washroom all the time when I was on there, but I'm just washing. I was just literally with the water running, washing dishes when I'm on a call, because the AirPods are so sensitive.
Yeah.
Yeah, so yeah, I'm actually not in the bathroom. I'm just doing dishes. And people are like, "Are you seriously always doing dishes?" And I'm like, "It, what? It keeps my hands busy. It keeps my mind busy." And so
Sure.
yeah, if you wonder what
So,
I do, what I
uh,
do for
wh-
fun, I
sure.
cook and I do dishes.
So, are you having to see the doctor with all these belly checks you're doing? I noticed your feed. You got some amazingly tasty meals all the time, and I just
You know
wonder
what?
if it's like TV. You can only have a bite, or
You know what? No, no, I do enjoy the food. One thing I did have to do again a while ago though was start working out, start walking a little more, start exercising a little more because it is part of the business, of eating
yes,
and trying the restaurants. So yeah, when typically if you see a hotel I'm staying at, it's got a gym in it, and I'm probably there at very strange hours because I'm awake and I don't sleep well when I'm on the road. I don't, so I probably you can find me in the gym at if it's 6 o'clock here, it's probably really early out there, and I'm probably BC time, Vancouver. You can probably find me in the gym at weird times. So it keeps me active, it keeps my mind busy, and honestly, we're having fun. And people say like what's the biggest thing that keeps you up at night? I get asked this quite a bit. And I answered this to a couple institutional investors recently, and I said excitement. And I said, because you bust your ass off to build a business and get it out of the trenches and get it out of the junk, which is honestly where it was when we joined. And you put years of your life into getting to this point, and sometimes it doesn't even work, even if you do it. But for the first 2 years, it felt like we were skiing uphill, which is brutal. I joke with Tony, one of our investors, about that all the time. He used to talk about going backcountry and having to backpack up a hill. Basically, that sucks. I'm not a fan of cross country skiing. That's boring. That's truly boring. So downhill skiing is where we've finally entered now. And the biggest thing I believe as the steward and capital allocator today of the company that I need to do is stay on the trail. Don't do anything stupid. No tricks. No nothing. And just get yourself to the bottom of the hill. Like that's all we have to do now is execute. The ship is left. We're literally finally skiing downhill. I'm actually having a lot of fun now. Like it's fun when you're playing offense and you're able to grow and you're in a, basically an almost debt free situation like this today. Our competitors are not. And, I'm going to continue to work with our team, keep our foot on the gas and just under promise and over deliver. Just run a great business. And if you look at the guy, Bob Dylan, the founder of Main Street Equities, like who doesn't want to be that guy? He started $1 a share and now he's at $200 a share. That's something that you look up to in this business. For me, as a young consolidator, and people ask me about MTY. Oh, so do you want to be bigger than them someday? And I said, no, I just want to be better. That's what I want to be.
excellent. So they're at what 5, 6, 7,000 store locations these days.
7,000, and but I believe we have much better unit economics. I believe it will deliver better organic numbers. And we have somewhere between $500 million and $1 billion less debt than they do. So our foot's on the gas for organic growth and M&A. And I think I said this a year ago. We were at 50 cents. I said I think we would be the next one to double our share price before they would. And they're just a little extra gas in the tank, and keeps me going every day. I want to win. I'm being honest. I
And
want to
what's
win. And
great? And what's your next trip?
next trip, next week I'm in Calgary and Edmonton. Calgary, Red Deer, Edmonton. I'm with Mr. Steve Travers, Sleepy Steve, as some people joke and call him out there on social. But Steve is on fire. He's got more development coming at him than you can shake a stick at. Then I'm doing Atlantic Canada. I'm doing all the provinces in Atlantic, meeting our franchisees in real estate. And then I'm going to be up in your neck of the woods after that. We have some franchisees that are on the island and in the Okanagan that are looking to move forward. So we will be doing, Steve and I will be doing a tour through BC over the next 3-4 weeks. So I'm every week
Right.
for the
Well,
next
we
month.
could certainly use a good, tasty burger spot, and I wouldn't mind a coffee shop because where I am, we got nothing.
And a good acai bowl might be on your way if I have my way. So when I'm out there, I'll definitely look you up. And when we're open, hopefully you'll come down, and you and your family, I'll be happy to treat you to lunch.
Hey, well, thank you. Thanks, Sean. Really appreciate your time.
Thank you.
I think we covered a lot of ground here. I wish you lots of luck and continued good success sort of moving forward. And I'll tell you, certainly been just surprised with the acceleration of store openings. It looks like you guys have quite the recipe now. All puns meant in terms of how you do a store opening. Each one looks to be bigger and better, a line down the street. There's more balloons each time.
Yeah, the last 3 stores we've opened have set records for the company. To be honest, they
Yeah,
have. And
that's
so we're
great.
having a lot of fun. We've got a great team. But to your point, we are just starting to accelerate growth, and I hope that over the next 2, 3, 4 quarters, the shareholders start to see that on our financials.
So there's a concerted effort to get this pushed beyond $2 a share between now and the summer. Is that correct?
June 26th, we have to be over $2 a share, and for me, that's where my payday starts to get good. I was transparent since day one. A lot of people like on social media called me like every other name in the book for even saying $2, because But considering I didn't take any free stock or any free warrants or anything when I joined, I only really started to get paid above market and all the way to $2. And sometimes when we went from 20 cents down to 8 cents. $2 seemed like I needed a mining helmet on to figure out how to get there. Maybe one of your gold guys can help me, but I needed it. And now here we are, over $1, better financially than we've ever been, phenomenal pipeline, and a very forecastable growth picture for all of 25. So if we do deliver 25 and 26, I'd like to see us increase insider ownership. I'd like to see more insider buying, and I'd like to see improved financials quarter over quarter. And I want us to be at $2. Like John had just joined. John didn't take a pay cut and all the above. You know what I mean? Like his big part of his upside in his business and in his career is in the financials and in the warrants. So everybody in our team is aligned with our shareholders to get this to $2 by June of 26. If I don't, please have me on the interview and make fun of me.
Well, let's do that. That'll be, we'll have to come up with some sort of bet so that it's not just all downside for you. There's got to be some for me too. But hey, Sean, thanks so much for your time. You've covered a lot of ground here. We've done 57 minutes. It's April 7th. It'll probably be a couple of days before it comes out here. But lots of luck and success moving forward. Thanks so much. I appreciate your time.
Thank you very much, Kim.